Bitcoin dropped to $65,000, down 48% from the all-time high, breaking below the previous cycle peak from 2021. And here's the weird part. No panic selling, no retail capitulation. Just 9 straight days of steady, methodical, relentless downward pressure. Meanwhile, $5 trillion evaporated from global markets in 24 hours. No clear catalyst, no obvious headline, just markets collectively deciding that risk isn't worth holding anymore. And when Bitcoin breaks confidence like this, the narratives flood in. Exchange insolvency, regulatory suppression, quantum computing threats. People are literally tying Bitcoin to Jeffrey Epstein conspiracy theories. Every explanation, all at once, competing for your attention and your fear. So the real question isn't just, why is Bitcoin down? It's, what does this moment actually tell us about how markets work when everyone's playing chicken with reality? Here's what I'm going to show you. How this drawdown is less about Bitcoin and more about a massive repricing of risk across every asset class. Why the selling pattern tells you exactly who's driving price down and why they're doing it now. And what historical patterns say about where we actually are in this cycle. Because understanding the difference between noise and signal is the only thing that keeps you solvent when everyone else is losing their minds. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Look, let me give you a framework for understanding what's actually happening. Think of the financial system like a giant game of chicken, not the fun kind. The kind where everyone's driving toward a cliff, and whoever hits the brakes first loses status, but lives to play another day. The Federal Reserve is one driver. Commercial banks are another. Institutional players, retail investors, foreign governments holding treasuries, everyone's in their own car watching everyone else, trying to figure out who blinks first. Bitcoin's price right now, it's not breaking because Bitcoin changed. It's breaking because one of the drivers tapped the brakes. And now everyone's scrambling to figure out what they saw that nobody else did. Here's the thing about market sell-offs that nobody wants to admit. The story comes after the price move, not before. Price drops first. Then human brains, which can't handle randomness, reverse engineer a narrative to explain it. Right now, Bitcoin's relative strength index, the RSI, is lower than it was during the COVID crash in March 2020. Lower than it was at the bottom of the FTX collapse in 2022. That's not a prediction of where price goes next. It's a measure of how one-sided the selling has become. It tells you fear and forced liquidation are at extreme levels. And historically, those conditions show up near the end of drawdowns, not the beginning. But your brain doesn't care about that. Your brain wants a villain. So let's talk about the villains everyone's pointing at. Theory 1, campaign selling. That's veteran trader Peter Brandt's term for what's happening. Not panic, not retail giving up, methodical institutional selling. The idea is simple. Large players are intentionally suppressing price before a major regulatory shift happens. Specifically, before the Clarity Act gets signed into law, which most people expect by the end of February 2026. Drive the price down now. Load up cheap. Then, when regulatory clarity arrives, flip the narrative, and short sellers get obliterated on the way back up. It's elegant. It's cynical. It might even be partially true. But here's the problem with that theory. It assumes coordination at a level that's hard to maintain in practice. Markets are competitive. If one institution thinks they're suppressing price to buy cheaper, another institution sees that and front runs them. Game theory says defection is more profitable than cooperation when the stakes are this high. So yeah, maybe some players are doing this, but attributing the entire move to a conspiracy gives those players way more credit than they deserve. Theory 2, exchange insolvency. Rumors have been swirling, particularly around Binance, ever since the 1010 incident. People pulling liquidity, order books looking thin. Whispers of fractional reserve practices. And look, exchange risk is real. We've seen it before. Mt. Gox, Quadriga CX, FTX. The pattern is always the same. Everything's fine until suddenly it's not. Withdrawals get delayed. Excuses pile up. Then one day, the doors close. So is Binance insolvent? I have no idea. Neither do the people spreading the rumors. But the important thing to understand is this. Even if an exchange is perfectly solvent, the rumor alone creates a bank-run dynamic. If enough people believe it's insolvent and try to withdraw at once, that liquidity crunch can cause the very insolvency everyone feared. It's a self-fulfilling prophecy. That's why I don't keep Bitcoin on exchanges. Not because I know they're going to fail, because I know I can't predict when fear turns into a stampede. Theory 3. Quantum computing is going to break Bitcoin's cryptography. This one comes back every bear market like clockwork. And it's based on a misunderstanding of both quantum computing and Bitcoin's security model. Yes, quantum computers theoretically could break the elliptic curve cryptography that secures Bitcoin addresses. But we're not close to that. The quantum computers that exist today can barely factor small numbers, let alone crack 256-bit encryption. And even if they could, Bitcoin's protocol can upgrade to quantum-resistant algorithms. It's not a death sentence. It's an engineering problem with a solution that's already being researched. But fear doesn't care about nuance. Fear hears quantum threat and imagines Bitcoin going to zero overnight. And that fear, even if it's based on nothing, can move price in the short term. Then there's the truly absurd stuff. Bitcoin is tied to Jeffrey Epstein. Epstein was Satoshi. I don't even know where to start with this one. It's so detached from reality that engaging with it feels like a waste of time. But here's why it matters. When markets get chaotic, people's sense-making apparatus breaks. They start pattern matching everything. They see connections that aren't there. It's a sign of stress, not insight. And the fact that these theories are getting airtime tells you more about the psychological state of market participants than it does about Bitcoin. But here's where it gets really interesting. If there's one clean narrative that actually did spark this unwind, it was the announcement of Kevin Walsh as the new Federal Reserve chair. Markets immediately started pricing in a hawkish shift. The idea that maybe, just maybe, this time the Fed could actually tighten without breaking something. That maybe they could control inflation without resorting to money printing. And that shift in expectation pulled risk appetite out of the market like a rug. But here's the thing. The constraints haven't changed. The math hasn't changed. The debt hasn't disappeared. The deficits haven't shrunk. Whoever sits in the Fed chair is trapped by the same forces that trapped their predecessor. James Lavish has this framework I love. He calls it the 4 doors. 3 of them are locked. Door 1, austerity. Politically impossible. Neither party will cut spending enough to matter. We tried with DOGE, the Department of Government Efficiency. We're still running $2 trillion deficits. The cuts aren't coming. Door 2, raise taxes. Also politically toxic. And even if you tried, there's a ceiling on how much revenue you can extract before you start killing productivity. Rich people leave, companies stop investing, you hit diminishing returns fast. We're seeing it in California and New York right now. Wealthy people are flooding into Texas, Florida, Nevada. You can't tax your way out of a debt problem when the tax base is mobile. Door 3, default. You could just refuse to pay your debts and reset everything. But why would you default on debt that's denominated in your own currency? That makes no sense. If you control the printing press, you don't default, you print. Which brings us to door 4, the only door that's actually open. Print money, inflate the debt away, devalue the currency. It's not a policy choice. It's the only option left after you've ruled out the other 3. And Bitcoin exists because door 4 always wins. Now you might be thinking, okay, but what about Walsh being a hawk? What about his reputation for tight monetary policy? Here's the uncomfortable truth. It doesn't matter. He's not walking into a blank slate. He's inheriting a system with $36 trillion of debt, trillion-dollar deficits, and a bond market that's already nervous. If he tries to keep rates high, he breaks the treasury market. If he tries to let long-term yields run, he breaks the housing market and commercial real estate. If he does nothing, inflation comes back. He's not making choices. He's managing constraints. And those constraints all point in one direction: more money printing. Maybe not today, maybe not this quarter, but eventually, because the math doesn't leave another option. This is what James Lavish means when he talks about yield curve control. Right now, the Fed is doing what they call soft QE, buying short-term treasury bills to keep bank reserves high enough to support the velocity of capital the economy needs. They're calling it regular market operations. It's not. It's quantitative easing with a different label. And eventually, they're going to have to extend that to longer dated treasuries. Operation Twist, full QE. They have no choice. Maybe it takes a crisis to force their hand. Maybe it just takes the 10-year yield hitting a certain level. But it's coming. And when it does, Bitcoin reprices violently to the upside. Because Bitcoin is the only asset that's genuinely scarce in a world where everything else can be printed. Let me give you a concrete example of what this looks like in practice. Let's say you're an institutional allocator managing a $200 million portfolio. You've got 60% in equities, 30% in bonds, 10% in alternatives. In January 2026, everything's fine. Stocks are up, bonds are stable. Then Kevin Walsh gets announced. Bond yields spike. Your bond allocation drops 8% in 2 weeks. Your equity allocation drops 12% because rising rates compress valuations. Your alternatives, which include a small Bitcoin position, drop 48%. On paper, you just lost $26 million. Your investors are calling. Your board is asking questions. What do you do? If you're like most institutional players, you de-risk. You sell the thing that's down the most because it's the easiest to blame. You can't sell all your stocks. You can't dump all your bonds. But you can get out of Bitcoin and tell your board you're reducing exposure to volatile assets. It's a career preservation move, not an investment thesis. And when thousands of allocators do this at the same time, you get 9 days of steady, methodical selling. No panic, just institutions managing their own internal politics. Here's the part nobody's talking about. This isn't a Bitcoin problem. This is a everything is repricing risk at the same time problem. Gold dropped. Silver had a massive liquidation event last week. Equities are bleeding. Bonds are volatile. $5 trillion doesn't disappear because Bitcoin did something wrong. $5 trillion disappears because the market collectively realized that the risk-free rate isn't what they thought it was. That the assumptions they built their portfolios on were wrong. And when that happens, correlations go to 1. Everything sells off together. Bitcoin isn't special in that environment. It's just more volatile, so it moves more. But here's where it gets more interesting. What's actually happening right now is a knowledge arbitrage. That's James Lavish's term, and it's perfect. A knowledge arbitrage exists when price is moving before understanding has caught up. Most people still don't understand what Bitcoin is. They think it's a tech stock, a speculative gamble, a Ponzi scheme, something risky to avoid. They're not asking what problem it solves. They're not thinking about it through the lens of monetary history. They're not looking at it as a response to systemic money printing. And because they don't have that framework, when price drops, they don't have anything to lean on. They just feel fear and they sell, or they never buy in the first place. Meanwhile, a smaller group of people who've done the work, who understand the incentives, who've read the boring documents, they see this differently. They see a system that has no choice but to print. They see a Fed that's trapped. They see a global debt problem that can't be solved with austerity or taxes. And they see Bitcoin as the asymmetric bet on the inevitable outcome. That gap between those two groups, that's the knowledge arbitrage. And it's why this phase feels so lonely. Because when you understand something most people don't, drawdowns feel different. They don't feel like failure. They feel like friction. Like the market hasn't caught up to reality yet. And if you have conviction, that friction is where you accumulate. Here's a story that illustrates this. In 2021, I bought Bitcoin all the way up. $60,000, $65,000. I even bought at the top $69,000. I was euphoric. Everyone was talking about Bitcoin. Institutional adoption was the narrative. It felt obvious. Then it crashed. FTX collapsed in November 2022. Bitcoin hit $17,000. I rode it all the way down. That was not fun. It didn't feel smart. It felt like maybe I was wrong about everything. But I didn't sell. Not because I'm some kind of hero, because I kept going back to the fundamentals. I kept asking, did the US debt go away? No. Did the Fed stop printing? No. Did Bitcoin's supply cap change? No. The thesis was intact. The price was just catching up to a new reality. And looking back now, That period, that painful, isolating period, that's where real conviction gets built. Not at all-time highs when everyone's a genius, at the lows, when you're questioning everything. And here's the thing about people who hold Bitcoin through these cycles. They're not dumb. They're not gamblers. They're engineers, doctors, energy traders, entrepreneurs, people from every background who independently came to the same conclusion, that Bitcoin is the best form of money humans have ever created. And they formed that conviction while the world hated it, while governments tried to ban it, while headlines mocked it, while their friends called them crazy. That's not a coincidence. That's selection. Bitcoin attracts people who can think independently and hold conviction under pressure. And I'm not betting against those people. Now, let's talk about what you actually do with this information. Here's the part that matters. First, understand that Bitcoin can go lower from here. I'm watching the 200-week moving average, which sits around $58,000. Historically, that's been a bear market floor. It's where long-term buyers step in. It's where forced sellers tend to finish. Could we go there? Yes. Could we go lower? Also yes. Acknowledging that doesn't weaken your thesis. Pretending downside can't happen is what breaks people when it does. Second, if you're holding Bitcoin, this is where dollar cost averaging makes sense. Not trying to catch the exact bottom. Not timing every move, just consistently converting excess capital into Bitcoin over time. That's how you smooth out volatility and build a position without getting wrecked by short-term noise. And third, if you're serious about holding Bitcoin long-term, it cannot live on an exchange. Not Coinbase, not Binance, not anywhere someone else controls the keys. This is where self-custody and proper structuring matter. Because if this is generational wealth, if this is a multi-decade hold, you need to treat it like that. Here's what I'm not saying. I'm not saying Bitcoin can't go to $50,000. I'm not saying this is definitely the bottom. I'm not saying there's no risk. What I'm saying is this: the system is trapped. The Fed has no choice but to print eventually. Bitcoin is the hardest money ever created, and the people who understand that are accumulating while everyone else is panicking. That's the knowledge arbitrage, and that's the opportunity. Here's a quick sanity check. Imagine the Fed tomorrow announces they're done with tight money. They're going back to QE. They're buying long-dated treasuries. They're explicitly targeting lower yields. What happens to Bitcoin? It rips violently because everyone who sold in fear realizes they misread the moment. Now imagine the opposite. Walsh stays hawkish. Rates stay high. The bond market starts to break. Treasury auctions start to fail. What does the Fed do? They print because they have to. Because the alternative is a sovereign debt crisis. Either way, you end up in the same place. More money printing, more inflation, more debasement, and Bitcoin reprices higher. The only question is timing. Here's the comedic cutaway. There's this guy who called me in early 2025. He'd been dollar cost averaging into Bitcoin since 2023. Disciplined. Every month. Same amount. Then in January 2026, he sees the price dropping. He calls me, panicked. Should I sell? Should I stop buying? I asked him one question. Did you buy Bitcoin because you thought it would never go down? He paused. No, I bought it because the Fed's trapped and they're going to print forever. So nothing changed, I said. He hung up. 3 weeks later, he texted me. Bought more. Thanks. That's the whole game. Know why you own it. When the reason's still intact, the price is just noise. Here's another one. In 2022, after FTX collapsed, Bitcoin was at $17,000. I was talking to a fiscal lawyer I work with, guy who deals with high net worth clients. He told me one of his clients sold everything, all his Bitcoin, took the loss, couldn't handle it. 6 months later, Bitcoin was at $30,000. The client called back, wanted to buy again. But now he was angry at himself, angry at Bitcoin, angry that he didn't have the conviction to hold. The lawyer told him something I'll never forget. Bitcoin doesn't punish you. You punish yourself. Bitcoin just sits there, being Bitcoin. You're the one who sold. That client never bought back in. He's still watching from the sidelines, waiting for the right time. The right time was when he sold. He just didn't know it. So here's what you do. 3 things. 1, if you own Bitcoin, revisit why you bought it. If the thesis is intact, the price doesn't matter. If the thesis is broken, you should have sold already. 2, if you're accumulating, This is where dollar cost averaging shines. Don't try to be a hero and catch the exact bottom. Just keep buying. Consistent, disciplined, boring. That's how you build wealth. Not by timing moves, by surviving volatility. 3. Get serious about custody. If this is a long-term hold, it needs to be off exchanges and structured properly. Estate planning, multi-sig, backups, the boring stuff that doesn't feel urgent until it's too late. Here's the reality. This moment, right now, February 2026, is going to feel obvious in hindsight. Just like March 2020, just like the FTX collapse in 2022, just like every other time Bitcoin tested the resolve of its holders. The people who bought here, who held here, who stayed disciplined here, they're going to look like geniuses in 3 years. But right now, it feels terrible. It feels uncertain. It feels like maybe you're wrong. That's not a bug. That's the feature. That's the knowledge arbitrage. That's the price you pay for asymmetric upside. The game of chicken I talked about at the start, here's who loses. The people who blink first. The people who sell when price drops because they don't understand what they own. The people who let fear override their thesis. And here's who wins. The people who understand the system is trapped. The people who know the Fed has no choice. The people who keep accumulating while everyone else is running for the exits. Bitcoin's not breaking. The market's just repricing risk before it realizes the risk was holding dollars, not holding Bitcoin. Lazy investing built more fortune than crypto memes.